Welcome back to another video. In today's video we're going to be talking about what Bollinger Bands are and how do they work in forex trading. So let's get started. First things first, please read the disclaimer below. Once done, please continue with the video. Okay guys, I'm hoping that you guys have read the disclaimer by now, so let's get started. Bollinger Bands. Bollinger Bands, as a lot of people have been asking about what they are and how do they work in forex market. So this video is all about Bollinger Bands, how we use them, how we interpret them, how do we understand them, and how do we use them in forex market. So Bollinger Bands are basically a technical tool that a lot of traders use. It's developed by John Bollinger in the 1980s. It consists of 3 bands, which I'll be getting onto later on, and you can analyze different things by looking at this indicator such as the price volatility, the reversals, and so on and so forth. Again, it's a really popular tool that a lot of traders use for different various reasons, depending on the type of strategy they're using, depending on what they want to do in the forex market, i.e. buy or sell, whether they're looking to reverse the market or whether they're looking to continue with the trend. So it's a tool that's helped me personally in my trading as well, and I think that this tool is a great tool. Again, it's not 100% guaranteed, but it does work. So basically, on Bollinger Bands, it consists of 3 bands. It's quite similar to, I'll be showing you a picture of a Bollinger Bands later. So it's quite similar to, it's like moving averages, but it's around the price. So you'll have an upper band and you'll have a lower band. So it usually consists of 3 bands. There's 3 lines basically: the middle line, the upper band, and the lower line. And the middle line is typically a 20 days moving average, which is the simple moving average, the SMA closing price. While the upper bands and the lower bands, they're the standard deviations away from the middle band, representing the volatility. And I'm going to show you how they work as well. So there's, like I said to you, there's 3 bands: the middle band, the upper band, and there's a lower band. So how do we interpret them? Again, the middle band is a line that acts as it's a line that's in the middle, and it acts in between as a base between upper and lower line. And the upper band is the highest level of band. Upper band is the highest level of band. Again, this is where the prices gets to like the resistance type of thing, so we can use that as a resistance type of band. And the lower band is again opposite of the upper band, which is it acts like a support. So when the price drops and it acts as a support, so you're looking to we anticipate that the price is going to bounce off the lower band and it's going to go up. Vice versa, it's going to bounce off the upper band, which is the resistance level, and go down. So it's really important that we understand the dynamics of this indicator and how it works. Again, how do we interpret it? That's a really important part. So basically, Bollinger Bands, they're technically like a support and resistance type of indicator. You can also use that to measure volatility, depending on how wide the bands are, how close they are, where the price is, how the price is acting, at a certain price level or a certain band level. Again, it helps us to analyze whether the price is going to go up or it's going to go down, and whether the price is looking for a reversal, and so on and so forth. We can use these bands to measure different things, such as the market volatility. Again, like I've saying to you, it's a really important tool, and it helps us analyze how the price is reacting in the market. So like I was saying earlier, the wider the bands, the higher the volatility, and the narrower the bands, like the closer they are, that means the lower volatility. And high volatility is usually like when the bands are really wide and the price is just this got space to move in between. Whereas the bands are narrow, then the price doesn't have much space, and again, it's not going to be volatile. And in those conditions you can't expect the best results really, because there's not much for the market to move. Again, we can do other things like the overbought and oversold scenario. So like I was saying to you earlier on, it acts like a support and resistance. So when the price touches the upper band, we can consider that as as an overbought situation because it's gone to resistance level. And again, when it touches the lower band, we can consider that as an oversold situation, meaning that it's touching the support level. So we're anticipating a buy from a lower band and we're anticipating a sell from the upper band. Again, this can go a long way in your trading because it helps you analyze where the price is, whether the price is hitting those bands. Again, it can help you if you're looking for a buy, and if the price is in the overbought balance, then you might think that because the price, it can also help you skip the trades as well, like I'm saying to you now. So let's just say the price gets to an overbought band and it touches the upper band. Now we know that the price is already overbought, meaning that if you buy that high, then potentially the market can do a correction and it can stop us out. On the other hand, if the market is on the lower band and it's oversold and we're looking to sell, then because the market is already oversold, meaning that if we sell that at the bottom there, the price may do a correction, the price may bounce up, then it'll eventually stop us out. And so with these scenarios and with these bonds, you can use them to enter, but we can also use them to exit as well. Some people can use these bands as a take profit point as well, and that's something that I do personally. So when it gets to an overbought band, I'd want to be out of the position because I don't want like a sharp reaction to the price or to my position, meaning that it will take away the profit from my table. So I'll rather take what was made and move forward with it. So that's another thing that we need to understand about Bollinger Band and how it works. Again, like you can also analyze this. You can also use this indicator to analyze price reversals. So when it gets to the upper band, we can look for a sell. When it gets to a lower band, we can look for a buy. And again, sharp price changes that happen between the market as well. Between these bands, and we know what we're expecting. So when the bands are narrow and if the price is moving sharp, then we know that the price may be up for reversal. Again, it's something that we will have to practice, to preach, and then to get better at it. Now, there's another thing that's Bollinger Bounce. This is a really popular term that a lot of traders use. Bollinger Bounce is basically, it usually occurs between the bands, and which is let's just say if it gets to an upper bar, if it touches the upper band and it bounces, that's a Bollinger Bounce, meaning that now the traders know that market may be looking for a potential reversal. And when I say maybe, it's not guaranteed because it might just touch react, get a couple of positions, and then it might break through the bands and go above the bands as well. So that's another scenario. So it doesn't mean that just because the bands are there, the price is not going to break it. Price does sometimes break the bands, so we'll have to be really careful. We need to use proper risk management for it. Again, there's another technique that a lot of traders use. That's the Bollinger bandwidth. And like I was saying to you earlier on, like on the rising volatility and higher volatility, if the width is really big, then that means that we've got the higher distance between the upper and the lower bands, meaning that we can have better risk to reward ratios. We can end up getting better RRs. We can end up getting a better position, meaning that the probability of our trading will be slightly better. Whereas when the bands are lower, our probability will not be as high as it would be when the bands are wider. So this is something that we will have to see in the market before we enter the market. Now, this is an example of Bollinger Bands, and this is the way I like to use it. So I've got my up and the low settings as a blue line, so that helps me to see that it's getting to an upper band on the lower band, and the middle setting for the 20 SMA line, which is the middle band, I'll keep that as orange so I don't get confused. Again, it's a great way for it to separate. Like I was saying earlier on, as you can see here, the bands are narrow, and then we've got a better probability of the price going up. But as soon as it touches the upper bands, it's reacting And let me show you an example of a Bollinger bounce as well. There's a Bollinger bounce when it got there and it bounced from the level. So that's a support level, that's a support level, that's a resistance level. Again, here these are when the bands get really narrow and the price gets a bit shaky. So we don't know if we're going up, if we're going down. But whereas, can you see here when the bands have got really wide, meaning that we've got a better chance of the price going down. So this is something that we will have to practice and get better at it as we go by. Again, Bollinger Bands, we can use them in Forex because they work great in so many ways, and we can benefit from them in so many different ways. And we can also learn a lot from these bands. They can confirm signals, they can help us on the technical side of things. So they also help us in various ways, like the trend following. So when during the strong trend, the price tends to touching the outer bands repeatedly. So like I was showing to you in the previous examples, that it touches the bands, and then the traders can use that as an indication that we're following the trend. Like I've shown you the sell things example before, when the bands were wider and the sells was going down. So when the bands were a bit, if they were touching it and they're respecting it, meaning that we're looking for a trend following thing. We can also use that as trend reversal thing. So when I showed you earlier on, when it touched the lower band and it bounced from it, so it was a Bollinger bounce type of thing. So we can potentially look for a buy after a double bottom pattern, or a double bottom, or a triple bottom for as well, followed by an engulfing, and so on and so forth. So this is something that we're gonna have to work on it. But again, bands do help us to realize and analyze what's happening in the market and take a better position and be on the better side of the market. Again, we will have to practice just to get perfect at it. So like I was saying to you earlier on, this gives us reversal signals as well, and it also gives us breakout trades. So breakout trades is when obviously the bands are like, there's a breakout followed by a substantial volume, and then this can give us a good indication for entry as well. So this, the bands, Bollinger bands, they can get squeezed and then obviously followed by a breakout, and then it can give us a very good entry signal to know that now we can look for a buy and now we can look for a sell once a breakout happens. So this is something that we're gonna have to practice again. Like I showed you my example, you can take a screenshot of the example as well, so that you're not getting confused. And I would suggest